Welcome to our market webinar update. It's Tuesday again. Good to be back. And joining us today, we'll have a special guest who we'll get to in a minute. Before we do, I'm Brian Perry, and welcome to the weekly update that we've been doing. A couple of things. As we go along, if you have questions, there's a Q&A button in the bottom of your screen. Go ahead and click on that. Ask any questions you have. We'll get to as many of them as possible as we go along, and at the end, we'll have time for Q&A. I'm Brian Perry, like I said, chartered financial analyst, certified financial planner. I'm director of research here at Pure Financial, executive vice president. Joe Anderson, not with us this week. He'll be back next week. This week, we have a special guest instead. We've got Apollo Lupescu. He's a PhD, a doctor, vice president over at Dimensional Fund Advisors, incredibly intelligent guy, but also really, really good at boiling things down into terms people can understand. So excited to have him here. In a moment, I'll be throwing some questions and answers over to him to ask him some and let him weigh in on what's going on in the world. Before we do that, again, we want to keep everybody safe, healthy here. We're continue to work mostly remotely with just a skeleton staff in the office, but we're fully operational. Any resources, any commentary we're putting out, any comment on the market or our COVID-19 response is all accessible through our homepage. Again, importantly, we continue to be fully operational in all ways. Just reach out. We're here to serve you and get you through this difficult time. Also, one thing that's come up over the last week or so is a lot of the meetings now are on Zoom, and that's pretty common across the country, across the world. And there have been some security concerns about Zoom, some issues with people joining other people's meetings. Not at Pure, but it's been in the news where people are bombing into meetings. We've taken some steps with our IT team to prevent that. So we've got some additional encryption on those Zoom meetings up to the highest industry standards, doing everything we can to keep things safe. We've also now password protected all of our meetings to keep you all safe. Those passwords are actually encrypted within the meeting, so you don't necessarily need to do anything, but just know that on our end, behind the scenes, we have our IT department doing everything they can to keep things safe and make sure that everybody is secure in this environment. With that, we're going to get started. I want to do a market update with Apollo, and I'm going to throw some questions over to him. And then at the end of that, we'll turn it over to some of your questions and answers. And what I want to start with here is a question for Apollo is that, there's a lot going on. And if that isn't an understatement, I don't know what is. But I want to start with not what's going on so much in the economy or the mechanics of the economy, but to start with people. Start with the human element. And Apollo, I mentioned at the beginning that I think you're really good at boiling things down to the people part of it. And so can you give us a sense of how investors are feeling about the markets these days?
Right. Well, first of all, Brian and the Pure team, thank you so much for the invitation to be here. And thanks to everybody for attending and taking time out of their afternoon to be with us. And it is actually a really important question because investing the last few weeks has not been the only thing on people's minds. Obviously, first and foremost is the health crisis, and we're all dealing, and we're all kind of emotionally have to address the fact that we might be getting sick, and you see there's so much uncertainty and anxiety around the health crisis that we're dealing with. And then on top of that, you have the economic crisis that is created, that you have all these businesses that are being closed, whether they're small businesses, larger businesses, and everywhere you go, it just seems like the economy shut down. Even the beaches are shut down here in Los Angeles. And then on top of that, you have this market component that you hear about every day. And that really has caused people a compounded level of anxiety. And to really give some perspective to what I've seen in the markets in terms of people is over the past 11 years or so, we have had a really nice run in the market. And for 11 years, the market's been steadily going up. And what's been remarkable about the last 11 years is pretty much how unremarkable they have been in terms of choppiness, volatility, fluctuations in value. In other words, when we look at the market, we do expect a certain level of fluctuation. Markets go up and down, they bounce around. That's the nature of it. What's been interesting from an investor behavior perspective is that the past 11 years, we have gotten used to markets being unusually quiet. That's been the big thing with the last 11 years. We have been conditioned to believe that the market just slowly goes up. Every once in a while, there's a little pull down. But overall, the people have been really happy with the investments and really comfortably buying in the market. And in that respect, it has given a lot of folks a level of comfort. But we did feel for many, many years, and you and I, Brian, we had sessions where we talked about this, that the market is unusually peaceful, it's unusually quiet. And at some point, we know there will be some bumpiness in the road. Well, it turns out that the bumpiness came very, very sudden, and we had this very large drop in recent weeks. And not only that people are now unhappy about the market and feeling like this is not looking good, and there's a lot of concern out there. But what's happened is that after all these years of a smooth ride, now that we run into some rough waters, emotions that have been bottled up and that they really haven't been in the forefront of investors are now surfacing. And concern, anxiety, and to some degree, fear is creeping back in. And to me, I have to say that this fear is an emotion. There's nothing wrong with it at all. Like, I think it's okay, absolutely fine to feel it this way. It probably helped us as a species when there's an animal chasing us, and you see it, and well, you're afraid, and fear leads you to flee and perhaps save your life. And in this case, what it triggers some people to consider is maybe the market is a pretty dangerous place to be, and selling might be a way to escape this danger. And the cycle of emotions that we've seen has been quite steep, and there's been quite a lot of ups and downs, not on a matter of weeks, but days, and even within a day. And I have to tell you that as I said, emotions by themselves are not really an issue, because that's our human nature. It's okay to feel the way you do. I think that what we've seen is that lately these emotions have run counterproductive to successful investing. And why is that? Because the basic premise of investing is you want to buy low and sell high. That's just very basic. And if you think about the cycle of emotions, typically you feel good about buying when the market goes up. And that's when you're kind of like, yeah, it's okay to buy. But also when the market drops, that's when you sense the panic. That's when the fear makes you consider selling. So to me, this is, you got to be aware of it. And you have to be very cognizant of this roller coaster. In fact, it does look like a roller coaster of emotions, of investor emotions, that doesn't always lead you to make the best decision when it comes to your money. And it's just acknowledgement, that awareness about it. And in fact, it is like a roller coaster. Let me tell you, because I took my daughter to her Six Flags in Los Angeles last year with her girlfriends. And frankly, being on the roller coaster, I knew that my stomach was about to turn, but I'm better off staying in my seat rather than try to get out. And I think it's exactly like that in the market. That's actually a good analogy. If you think of a roller coaster, yeah, your stomach is turning while you're on the ride, but you are better off staying in your seat rather than trying to jump out. And to me, that's what I'm suggesting, is a way that through Pure and through your advisor, be able to disentangle these emotions from investment decisions, and pay attention to emotion, but do not make investment decisions that are clouded with emotion. And that's what I've seen lately, is much more so after such a long period of quiet times, emotions resurfacing, and people considering making decisions, not because they're analytical, but rather because they're clouded with emotion.
Thank you, Apollo. So good. And right, I mean, emotions rule everybody all the time. And there's nothing wrong with feeling those emotions. It's when people act on them that they start to get hurt. And, that goes back to the financial planning and the investment policy statement, and trying to put some guardrails in place to keep people on course. Let's kind of go 180 degrees in the opposite direction. So that was kind of the human element. Let's go more to the market structure element here. And, back in 2008, one of the issues was that really the plumbing of the financial system started seizing up. Banks couldn't lend or wouldn't lend. And we really saw the financial system come close to a complete collapse. Now, flash forward a dozen years, we've got potentially a recession. We've got a stock market sell-off. We had some somewhat crazy moves in the bond market. How's the underlying strength of the financial system right now? Is everything going to be okay, or are we back in another 2008 scenario?
Look, talking to economists out there, it doesn't seem to be like, when it comes to the financial system as a whole, it doesn't seem to be the same underlying problem, because I think that back in those days, the bank to some degrees were considered to be the culprits. They're the reasons that we got in this mess in 08, 09. Whereas right now, the banks are in much better position, and to some degree, they're considered to be maybe a solution to this problem. So I'm not sure that the financial system as a whole is in dire straits. I think there are certain parts of the market that if you look at commercial paper, where you look at treasuries used as collateral, those did have some bumpy times, but the Fed intervening and stepping in and saying, you know, it's going to be okay because we have your back. It just seems to have normalized those markets. But our main experience is in the stock market and the bond market. And when it comes to these publicly traded securities, what we're seeing is that the pipelines are still functioning quite well. And us as a firm, and in fact, not just us as a firm, but many other firms out there have used technology for quite a while. And it was a pretty seamless transition from everybody having to be in the office to working from home. And we have not experienced any disruptions at all. Like, we're functioning 100% without a problem. And when you look beyond that, the markets are also working well in two or three other regards. The first regard is that the markets have done a really good job reflecting the fact that the value of companies, which is tied to future profits, has declined because, you know, as opposed to January, when we had a certain expectation of the profits, or at least the range of the profits for companies, the markets has done a good job adjusting to the new reality that in this environment, at least for right now, it doesn't seem that the companies won't make as much money. And what I'm really saying by that is that the fact that the market dropped, as we have seen it dropping, that's a sign of a well-functioning market. Because it's basically suggesting that you as an investor, you should not be paying as much as you did in January for the same company, which now has a lower prospects for earnings down the road. So to me, it's a very good sign. And in fact, people are, when they're pointing the fact that the market's dropping and that's a bad sign, the market's not working, I would say it's exactly the opposite. It's really kind of taking into account the new reality, and that's what you want to see. I would have been shocked if it hadn't happened. And the other thing that makes the market still work very well, and it's one of the primary functions of the market, it's as it said, it's a marketplace. And in this marketplace, there are millions of the deals being made. And on each side of the deal, there has to be a buyer and there has to be a seller. And in the context of this, everybody has bits of information. Everybody has an expectation about the future. And right now, there is no consensus that everybody agrees that the market will go up or they'll go down. In fact, the market that still works very well is reflected in the fact that the buyers and the sellers still have no problem exchanging shares of ownership. And you have to think that for everybody who thinks the market will go down and sells because maybe that's going to go down, there is a buyer who buys because the market might go up. And right now, there are millions of these deals being made every day. And for every pessimist who believes the market will go down, there has to be an optimist who's buying, thinking that the market's going to go up. So right now, there's perfect disagreement in the market among participants. And just to kind of share one quick statistic with the folks, if you're looking at just how much is being traded every day, there's roughly $500 billion almost every day in these deals that are being cut among investors. And that is still working. That is, there's still that venue and people can participate. And when you have all these trades and you have all these opinions being put together, really what you're getting is sort of the combined wisdom, the combined expectation and forecast for a variety of folks put in this hopper called the market, and that spits out some sort of a fair value for each company in the market.
Awesome. You know, I'm going to turn to what I've heard described as the four most dangerous words in investing, and they are, this time is different. You know, and so the question, something along the lines of, right, that this is an unprecedented environment. And I think for most of us, that's probably true. We haven't necessarily dealt with a pandemic on this scale in most of our lifetimes, at least. And we certainly haven't dealt with shelter in place that I can remember in my lifetime. People's daily lives are certainly disrupted. There's fear of getting sick, like you mentioned at the beginning. And then, you know, financial markets are dropping, which certainly isn't unusual, but it has been a while. In times like this, turning to the past seems to help. And so is there any lessons or guidance people can take that maybe this time isn't different and maybe we will be okay?
Right. Well, you know, actually, it is important to acknowledge, and I think you got it right. These are dangerous words. This time is different. But I have to acknowledge people's reality, and I think that at least to me, and to you know, just to people around me, like all of us, it does feel different. I mean, I've been at home with the kids, and they haven't been to school in weeks, and all the restaurants are closed, and you know, you can't walk on the street out of the mask. This feels different, and it is different. It's unprecedented. We have never seen anything like this. There's no doubt in my mind that I can't think of a situation that in my lifetime I can recall doing all this. I think back in Europe, there might have been in 1980s, there was the Chernobyl explosion. And I think for a few weeks, everybody was contained in their home. But that's the last time that I really remember that everybody was stuck at home the way we're now. Now, that is absolutely true. It's unprecedented. And this coronavirus itself is unprecedented. We have never seen a bug just quite like this, a virus quite like this. And I think, Brian, you asked the right question. Even as this virus is unprecedented, we have never seen anything of this type of coronavirus. Perhaps it is useful to look at other coronaviruses and draw some lessons that would help with this, deal with this one. And I think you got the right attitude. It's like right now, this is unprecedented, but perhaps there have been times in the past when you can look back and say, you know, the world is different. We've never seen anything like this. It's unprecedented, and the world might never be the same. There were instances, and we can draw some lessons from there. And obviously, 0809 is the big one with the unprecedented nature of the financial crisis and perhaps the collapse of the financial system in the U.S. But the two that I have been exploring lately, just because I wasn't really there, but I wanted to understand them better, are times when either I was too young to remember or I wasn't even born. And I'll bring up quickly those two crises that I think have important lessons for us today. The first one is 1973. And in 1973, early actually in the 70s, there were a few things that happened. And I want you to think about how meaningful they must have been if you lived there to hear these news. The first big one was that up until the early 70s, the dollar, the value of a currency, of the dollar bill that we hold, used to be based on gold. And there was something called the gold standard, that in order for the government to issue another dollar bill, they had to have gold, because they pledged that if you bring your dollar bills, $35, we will give you an ounce of gold. And that was the standard. That was, everybody knew that the dollar bills are backed by precious metal. Now, in the early 70s, first you went from 35 to 38 to 42. But by 1973, what happened was it was pretty much clear that the government said, we no longer honor that pledge. The dollar will no longer be tied to gold. And think how it must have felt to people that the whole life you know that what you work for is a piece of paper that you can go get gold, and it's backed up by something physical. And now the only reason that money has value is because other people believe it has value. And there was a very different mindset. And you ended up having inflation. There were price controls, wage controls. And in the fall of 73, something else happened. There was a conflict in the Middle East. And to show their displeasure with the American policy, the Organization of Petroleum Exporting Countries, or OPEC as we know it, decided to put an oil embargo against the US. And all of a sudden, we ended up in this oil crisis. And again, I wasn't there to see it, but it's remarkable what happened. At that point, we ran out of gas. There were lines that were going forever, and you would have to wait for hours to get gas. Sometimes you wouldn't get to it. And think about the headlines. And I'd love to build a time machine that would take me into one of these cars while I wait for hours. I have a newspaper in my hand telling me our currency is just a piece of paper that's not backed up by nothing. On top of it, the entire economy depends on a commodity that comes from countries who are not friendly to us. We're doomed. We don't have enough fuel to go to school, to go to work, to go grocery shopping, let alone transport food around the country. This is different. It's unprecedented, and I don't know how we'll get out of it. Imagine that, being in that car for hours reading these headlines. It must have been really petrifying to most people. And what happened? What are the lessons that are important for today? Well, what happened was, as we got over the crisis, we ended up passing a legislation on the fuel efficiency of cars. And we went from the gas guzzlers of the 70s to much more fuel efficient cars all the way to today. And then the other thing that happened is all of a sudden you realize that you have to have energy independence as a country. And right now we have become one of the largest producers, and not the largest oil producer in the world. And I think that it ties into this coronavirus in two ways. One, when you look at this coronavirus, it is bad and it's impacting people. It's devastating to families. And it's possible that down the road, you can have another pandemic that could be even worse. But after going through this, it is quite possible that our lessons that we learn that would enable us to deal with something worse down the road. The same way that we dealt with the fuel crisis by being more fuel efficient. And furthermore, right now, the supply in these companies, the supply chain is really designed to maximize profits on demand and coming from all over the place. And maybe after this, there will be a national security look at the supply chains. And similarly to the way that we had a look at the oil supply after the oil crisis. And it's possible that when you fast forward 30, 40 years, we might see that the economy has changed, but not necessarily in the bad ways that we might see today. So that's the first time machine that I want to build. The second time machine would take me back to World War II, because that was the only other time that I know of that we had such a massive disruption of the workforce. Folks, what we're going through right now, it's not a recession that's caused in the traditional way by the lack of demand. People don't have jobs, they don't have money, they don't spend money. That's not what's happening right now. It's a very different type, and it's more of a supply side that people can produce, companies can produce, because people are stuck at home. And it was like that in World War II when everybody got shipped off to war, and he had a big supply disruption. And if you think about this, by the time the war started in late 1941 for the U.S., by then, 4 out of the last 5 years in the market were negative. In fact, 1937, it dropped almost as much as the great financial crisis. So once again, let's take the time machine, and now you're in like this living room in a house. It's dimly lit, and there's an old radio spitting out all these bad news. And you're thinking about, well, how is the market going to do? Well, you know that historically it's 9-10% per year, but boy, this does not look good. You've got millions of people dying, cities destroyed. Forget about supply chain and all that stuff. It's a terrible situation. And yet, what's remarkable is that 42 to 45, the darkest days of our parents' generation, the U.S. stock market grew on average of 20% per year during the war years, which is mind-boggling. The darkest days. $1 invested at the beginning of the war would have pretty much doubled by the end of the war in 4 years. So it is remarkable. And you can have that cynic view that war is good for business. I would say there's something else that is with us today. And that is the fact that in a free market, in a capitalist world, these companies will find a way to seek opportunity and basically make money in whatever state of the world we're in. Back then, if they couldn't sell cars, they probably made tanks. If they couldn't sell toys, they made bullets. They found a way to make money. And it's exactly the same today. You have distilleries who don't make spirits anymore, but they make hand sanitizer because that's what sells. You have, Ford and GM announcing that production lines are being reconfigured to produce ventilators just because that sells. And to me, it is this big reason for optimism, the same as we had back then. These free markets will help us go through this. Markets are resilient because companies are resilient. These CEOs work in their pajamas from home. They're still looking to say, how do I get back to being a viable company? And then, the companies are resilient because people are resilient. We're all resilient, and mankind as a whole is resilient. And I think that has not changed. So to me, these two periods, I thought it's worth mentioning that it is different this time, without a doubt. And perhaps when we look back, we'll see that there will be some changes, and some of them might not necessarily be, bad. Some of them might, I don't know how it will play out, but eventually the resilience of the free market system, the resilience of mankind will help us get through this.
Cool. That's really good stuff. Thank you. and I love the sort of looking for the optimism out of the sea of negativity, right? Because there's always two sides of that coin, and all else being equal, yes, stocks are down, but people go to the mall when stuff's on sale, right? So,
Yeah.
speaking of which, right? So stocks are down. We've had probably about a 20% rally off the bottoms, but we're still down, fairly significantly over the last 6-8 weeks. What's happened in the past when markets have fallen like this, or when we've been in this kind of environment? Is there any data on that we can look at? Pure's a data-driven firm. Dimensional's a
Right.
data-driven firm. Is there anything you can tell us on that?
Yeah, no, and we have looked at this, and what we see is that we'll just take roughly a 20% drop, the one that he mentioned, Brian. So when you look historically, what you see is that the history of the U.S. stock market has been pretty much a sequence of ups and downs in the market. So it hasn't consistently been up or down. So when you put a 20% threshold for downturns, what you see is that we did have a number of these bear markets where the market dropped 20% or more. But by and large, what you see is that the bull markets tend to last on average longer than the bear markets. And it's not really predictable to say when they happen. On average, if you put a rough average, it's once every about 10 to 12 years. Which is pretty much what we've seen since the last bear market that we had. So in that respect, the data is suggesting there's really nothing that unusual. We've seen this in the past. It's not common. It's once every 10 or 12 years, but that's roughly the time since we last had a downturn of this nature. Now, the question that is also significant at this point, once we do see these downturns, these 20% downturns, what do you see in the market afterwards? So in other words, if you fast forward and you know that historically the markets return 9 to 10% over the long run, the question now is, if you look at the 20% downturn, what do you see 1 year after? Does the market continue to slide, or does it go up? And obviously there are different periods, but when you average them out, what you see is that 1 year after a 20% market decline, the market, the S&P 500, actually this is the total market research index. What it shows you is that the market goes up by roughly 14%. So once we have a drop of 20%, what you see is that on average, among all these periods after a 20% drop, you see an increase afterwards, and it's quite significantly more than the long-term trend in the market. That is sustained over 3 and 5 years, which once again, it's good news. So when we look at the data, we see there's variation in terms of what happens after, but on average afterwards, the market, whether it's 1, 3, 5 years, is continuing to grow at a rate that is higher than the long-term average.
Cool. So, so that gives us a sense. We've talked a little bit about some of the human element, and then we've talked about some of the historical precedents and now the data. So given all of that, and given where we are today, who knows where we'll go in the future, but given wherever we might go in the future and what history tells us, what should investors do now? Is there anything specific that investors should do differently when markets fall? And and I guess I could break that into two parts. Is there any difference if somebody's approaching or in retirement versus other investors?
Yes. So there are, first of all, what I would say is absolutely there are things you can do. I don't believe that one of those things should involve selling because you're afraid that the market might drop more. I don't think that is the right way to go because it's really not possible to know when to get back in. And it's also, if you miss the rebound, you might make a temporary paper loss into a permanent loss. So what is it that you can do? And what we suggest, and I think that what Pure and I and Mention are on the same page, is that as an investor, there are 3 things that you ought to do as you get close to retirement, or if you just simply don't have the stomach to take the ups and downs. And really, it starts with a fundamental presence. It starts with understanding that in the stock market, there is choppiness. That's just the price of admission. That's just what you get. And even though the average has been 9 to 10% per year, don't expect that to be a year to year occurrence. You barely see the average, if ever, in the U.S. market. It's really fluctuating a lot. That's just the nature of the beast. But the growth has been really nice. It's actually a little bit higher than the typical real estate market, whether it's LA, San Diego, or even San Francisco. But the rewards have been phenomenal in the market. This is the S&P 500. My dad was born in 1926, which happens to also be the year when we start having good data on the US market. And I was curious to see what would a dollar have turned in his lifetime had my grandparents put one single dollar in the S&P. It turns out that by his 92nd birthday, he's 93 right now, that dollar would have grown to about 7,000 bucks. So it's a lot of choppiness, but also a really nice reward. I wish my grandparents had put 100 bucks in there. But it turns out that as Brian said, sometimes you want to mitigate and you don't want to take the brunt of a market downturn. So how do you do it if it's not about selling out the market? There are three strategies that we suggest. The first one is not only buy ownership in companies, but also lend your money to corporations and the government. And when you lend them, there's a contract with a specified interest rate for a specified period. And at the end, you get your money back. And the most credit-worthy issuer is the U.S. government. In its entire history, it has never missed an interest or a principal repayment. And the safest of the safe, quote unquote, is the one that is very short term. You give the government your money, 30 days later, you get the money back plus interest. And that is called the 30-day Treasury bill. And when you look at the Treasury bill over the past 93 years, it fluctuates so much less than the stock market. And in fact, it has never had a negative year. There's not a year when you pull out a statement and say, well, I have less money at the end of the year than the beginning of the year. And the other good news is that you beat inflation. Inflation has been about 3% over the long run. This is about 3 to 4%. So it's a little over inflation. And so the question is now, if you had invested the same dollar bill over the same time frame in the safety of treasury bills rather than stock market, how would the dollar have grown differently? And I'd like you to just think of a number in your head. What would the growth of 3-4% versus 9-10 mean, knowing that 9-10 grows at 7,000? And there's a book here called the Matrix book, which is the big book of numbers, the encyclopedia of numbers. And we're able to look in that book and find out what the number is. The number is, for the same time period, same dollar, in the treasury bills, has grown to a whopping $21. Not missing any zeros. That's the trade-off in investing: stability versus growth. And that's why it's so important to figure out what is the right balance between stocks and bonds. It's the most important decision in investing, and the only way that you can get that right is if you sit down with an advisor at Pure and you have a financial plan that is built specifically around you. What are your circumstances? What type of income do you have? What other rents or pensions do you have? What is your risk capacity? Everything matters. And only after you have this, how many years you have to retirement? That's a big one. The closer you are to retirement, well, the more you might need stability rather than growth. So all of these are factors that go into the financial plan that would help somebody decide, will help the advisor decide what's the right balance for your specific situation. And you should talk to an advisor and find out what is the right balance and what is your balance right now in the portfolio. My guess is that the retirees are not as exposed to the market as you might think. The second thing you can do besides bonds is look at global investment opportunities, not just the US. If you redraw the world map, not based on landmass, but the value of all companies that you can buy and sell, this is what the world will look like. The US has about 3,000 companies that you can buy on stock markets, and they amount to about 54% of the value of all stocks in the world. There are 9,000 plus other stocks in about 40 other stock markets, and they're all something that you can tap into. It's an opportunity set, and we do that. We go and we buy these 9,000 companies around the world. And what's interesting, why is this a benefit? Well, last decade, the US did really well. The decade before, international did really well. You want that seesaw. When one does well, the other one might not, but they counterbalance each other. And what's fascinating is that Q1 this year, actually 3 weeks ago exactly, Brian, if you mind me, I looked at an article in The Economist, and what it pointed out is that when the quarantine was implemented in China at the beginning of the year, China was the worst performing stock market in the world. 3 weeks ago, the article pointed out that China had become the best performing stock market in the world. In other words, it had like that V shape that you hear about, a very steep drop, but then a very steep recovery. And their version of NASDAQ, the article pointed out, was actually in positive territory. So it was interesting for me to see, not only because it's maybe a sign of what could happen in the US. It seems like when they resumed activity, these things also came back to life, the economy and the market. But it's also a sign that it's good to buy globally. Right now, the US for quarter 1, as I checked, the US is not in the top 10 best performing stock markets. There are other stock markets that have done a lot better than the US. And more so, I also wanted to know, is China still the best performing as of the end of Q1 last week? And the answer is no. It's the second best. And the best performer, a little drum roll, is the great country of Denmark. Who would have known? But that's the beauty of having this comprehensive global approach. And the last thing that you can do is really have an advisor who has put something in place in advance of these events. And I live in Los Angeles, and probably the closest I can think of is, I know there will be an earthquake at some point, and you don't want to figure out on the fly when the earthquake happens what to do. You want to have a predetermined plan, and you basically execute that plan when it happens. And I think the advisors have exactly the same thing, and I know Pure has it. And there are two major elements of this that would take away the emotion. You don't have to react on the moment. The first one is something that's called rebalancing, which means that when the stocks drop, rather than look at them in panic, you say, well, I want to bring back the stocks to the right proportion between, stocks and bonds, let's say, that's optimal in the financial plan. And if you do this, then, first of all, it's a little contrarian because you're saying, well, the stocks are falling. Maybe that's a good time to buy. And that's what you do with the rebalance. But you do it because you want, when the rebound comes, not to be too light on stocks. And there was a huge benefit to investors in 0809. The second thing is to realize that in some cases, not every case, if the value of the investments have dropped and you are right now on the water, you could actually sell that investment, even though it might feel pain that I'm selling at a loss, and buy something similar. But in the process, you realize a capital loss, which for tax purposes can offset future gains. That is called tax loss harvesting. And once again, if you have this an advisor who has looked at this, and it may not make sense for everybody, but it's once again, it's part of that idea that you define a program, a system, something in place before the actual event happens, and that helps you stash away the emotions and not make investment that are just rash on the fly.
Cool. Well, thanks, Apollo. And that was actually a perfect teeing up for, we have just an update coming out over the next week or so that our chief investment officer is drawing up, talking about some of the rebalancing and tax loss harvesting activity that we've done where we had those systems in place. And we've done, in a lot of cases, as many trades in the last 6 weeks in those areas as we did in all of 2019, just given the volatility. So we'll send that around to all of you here shortly. With that, let's take a pause, and those were great feedback from Apollo. We really appreciate it. Let's see what's on everybody's mind. Andy, do we have any questions from the audience? And as a reminder, if you want to ask a question, there's a Q&A button on the bottom of your screen. Just go ahead and ask away. And again, we'll try to get to as many of them as we can. And if we don't get to your question during this webinar, then we'll either email us, we'll get back to you via email, we'll get back to you with your advisor or whatever, but we definitely will get you an answer.
Hello, and yes, we do have a few questions. As a reminder, yes, click that Q&A button to ask your questions. So if you have your hand raised right now, you'll want to lower that and type in your question so that we can get the answer for you. So the first question that we have is, the market has seemed to ignore the national debt. The debt is increasing rapidly, especially these days. What will happen when and if the market starts paying attention to debt?
Well, that's a very important question because we've had the stimulus package that was passed recently, and that's certainly a big, that's going to be a big expensive proposition. I think that beyond just the market kind of taking account into this, there are a variety of issues there. But let me address directly the question on the market. I think that whenever you have such a big government stimulus, which is not a stimulus, by the way, if you'd like to come back to this, it's just big spending, and it's a liquidity to individuals. Whenever you have so much money being spent by the government, that is certainly known to investors. So investors do pay attention to this. And to some degree, what they're seeing is that this liquidity package was basically saying we want to do a few things with it. One is just simply supplement the unemployment insurance, because the unemployment insurance was created about 100 years ago as a way to counteract communism, out of all things. And let's just give these workers who are replaced by machines something to live on, but never like the full wage. And with this, 10 million people on unemployment, it's so sad because every single one of those people is a human being who's going through a major disruption. Now you know that they can search for work. One of the premises of the unemployment insurance is that you have to go look for work. Where am I going to go to look for work? Everything is shut down. So it's just addressing in some of these. But the impact that is having is, first of all, I think the market has responded to that. Just if you're looking at that, by going, in a few sessions up about 20%, because it's realizing that this stimulus is really important to companies and households. And in that respect, most economists have really had positive views of this. It is creating a national debt, but I think that you want to address the first problem that you have. If you have a house on fire, and you see the fire kind of burning a little bit, you can't be concerned, well, what if I get the rug wet? I mean, that's fine. We'll deal with that later, but let's first kind of deal with the big problem at hand. So in that respect, I think that down the road, we might need to dry the rug. But right now, I think it's more important to address the issue that could snowball and make the national debt not that relevant. But the market, just to let you know, absolutely is taking this to account. And one way that you can see this is in the interest rate on bonds, because bonds are a loan that is obtained by the US government from investors. And right now, if the investors believe, and not just generally speaking, if the investors believe that the government does not have the ability to repay its loan, it will bid up the interest rate. And when you see that happening, that is a sign that the market believes that there are going to be issues. And that's exactly what we saw with Greece, for example. When Greece ran into the problems, they went from having an interest rate that was pretty much the same as the US to skyrocketing and having to pay investors a lot more to compensate them for the risk of not being able to pay back. So to me, if you want to know how is the market reacting, right now on the stock market has been positive. On the bond market, there is no sign that the market believes that the government will not be able to repay the loans, because even a 10-year bond is still very, very, very low right now.
And Apollo, I agree with all of that. And I would say with the 10-year note being really low, the second part of the national debt is what you really focus on, is how much it costs to fund the national debt. And even though the size of the debt outstanding has increased dramatically just recently, and indeed over the last 15 years, the interest rate paid on that debt has fallen commensurately. So the cost for the government to service the debt, even though the debt itself has grown, is actually quite a bit lower than it was historically. And so at this point, it doesn't seem to be an issue.
Correct. And you also have to think, you're right, it's not optimal to borrow so much money. It's not optimal to spend so much. But what's the alternative? I think it would be a lot worse.
Yeah, agreed.
All right, our next question is, as part of rebalancing portfolios, is there consideration for overweighting sectors that should rebound after being beaten down more than perceived value, and incorporating risk of things like bankruptcy?
Yeah.
Certainly, yeah. I mean, and obviously bankruptcy is something that's more of a company by company thing as opposed to a market wide thing. But yeah, we actually just recently made a change in our rebalancing process to allow those securities or those asset classes that should appreciate more coming out of a sharp market sell-off and potentially rebound more, a little bit more room to run. And so what we did was we widened the bands where historically we've rebalanced plus or minus 20% on an asset class. We widened it out to 25% for the stock asset classes, just again on the premise that we don't know when or exactly what form a stock rebound will take, but we do know that historically when stocks fall sharply, and getting back to Apollo's data, that they do tend to recover pretty strongly, especially in such a volatile environment. So we made that change in order to allow them to run a little bit more.
All right, our next question actually is, the S&P 500 index is now down 17.6% year to date after yesterday's 7% gain. Our portfolio is only 40% equity and 60% fixed, and our combined portfolio, including cash holdings, is still down 12.3% since 2021 after yesterday's market close. What has happened on the fixed investment side?
Yeah, so I'll take it briefly, and then I'll let Apollo weigh in. Is that, bonds historically have not been very volatile, and if you look last year, they posted really strong returns. So the main bond index was up double digits last year, which is pretty unusual. Coming into this year, they continue to kind of incrementally go up, and then we saw in the beginning of March, as this crisis began to evolve, some of the things that Apollo cited with a little bit more volatility in treasuries and corporate bonds and the like. We saw some of the bond values decline. And then the Federal Reserve and government came in and supported a lot of those markets, and a lot of those bond prices have recovered. But most of the kind of sideways movement, a little bit down, a little bit up in bonds, is due to interest rate fluctuations, where we've had pretty big moves up and down in interest rates, as well as some additional compensation investors are demanding from corporate bonds. But again, I think it's taken a little bit longer horizon. Last year, some of those bond indexes were up 12%. And so if you look over a 13, 14, 15-month horizon, to get high single digits or double digits on bonds is pretty darn good. We also, again, recently, we talked about this a couple weeks on the webinar, but we made a move out of some of the bond holdings that we have into some shorter term bonds with less corporate bond exposure. And that was simply a measure of taking some of those strong returns that we saw last year and into beginning of this year off the table, and also positioning portfolios for the fact that with interest rates so low, we don't think the risk reward is quite as compelling on longer term bonds as it usually is, just because theoretically there is some lower level to how low bond yields can go.
Yeah, no, I think those are great points. I absolutely great points, and I agree. I think that I would caution you too, is that you do want to have a little bit of perspective that this is a very short time. It's very choppy. And what happens on a week to week, month to month, give a little bit of time, because, the bonds, they're not flying through the roof, but they're not doing bad. I mean, there are categories within bonds. And I think Brian touched on this. Not all bonds are the same. So when you look at the bonds that are issued by highly, the high credit quality issuers, and they're short term, that's different than maybe some corporate bonds. And I think the one bond that you've seen kind of maybe taking a hit more than others, and I don't know exactly what specifically is in your portfolio, but maybe if there's some munis there, and munis for a while they haven't done very well. But to give you a perspective of the differences that you should expect in your portfolio, I'm actually going to follow up on your question. I think it's also good to do one more thing. Let's take the market, and you mentioned the S&P, and you looked at what happened in the S&P year to date, and you kind of, that's the yardstick that most people look at, the Dow Jones or the S&P. That's what's on the news. And let's go back to these, the largest downturns in my lifetime, being the 1973, the 2000 dot-com crash, and then the great financial crisis in 08. So what I want to reflect is we're looking right now at a quarter, which in the big scheme is painful to look at. But when we look at the market, how long can you possibly be in the red? So in other words, how many years can you be in the red in the market? And if you look at the S&P 500 back in 1973, it was 3 years in the red. By the fourth year, you're back in black. And the lowest year that you saw in that period was a negative 26% in 1974. So it's a big drop, and you can stay in the red for a while in the market. In the tech crash, it was 6 years in the red. It wasn't positive until the seventh year, and the worst would have been at negative 22% or so in 2002. And the last one is the great financial crisis. It was 4 years in the red. It wasn't positive until the fifth one, and it was a negative 37%. So the U.S. market is certainly, when you look at beyond just the quarter, it can be a very a long-term downturn. And we're talking about, look at the 6 years in the red, you don't see black until the seventh year. Now, the way that Pure and what we've been suggesting on this call, if you use the S&P and you say, I do want to hold the S&P, but I want to have a global perspective, international, developed, emerging, that's different than just the S&P. And then what if I balance it and I put some stocks and some bonds? And there are different levels to which you can do it, each to one circumstances. But the most generic one out there is called a 60-40. 60% in stocks, 40% in bonds. It's called a balanced 60-40. So how would a global strategy that is balanced 60-40, how would that have fared in these really negative downturns of the US market? Well, in 1973, instead of being in the market in the red for 3 years, you would have been in the market for down in the red for only 2 years in this portfolio. And the worst you would have seen was a negative 11%. In the downturn of the tech crash, instead of 6 years, you would have been in the water only 1 year, 2002, and there would have been a negative 3.6. And after the great financial crisis, 2 years in the red with a negative 24% at its worst. So there are two things that I want to mention to you. Three things. First of all, what you see on the news might not necessarily be reflective of your portfolio. And I'm so glad that you compared not just your portfolio, not just the S&P, but what you actually have. Secondly, the downturns in these very negative years were a lot less severe than in a global balanced portfolio. So even if you went down, it wasn't the same magnitude as being purely in the S&P, the US market. And thirdly, if you look at this, the longest you would have been on the water in the market in the US would have been 6 years. And yet the longest, going back in my lifetime, since we have data, and by the way, these are global balanced portfolios from this book called the Matrix book that I mentioned a second ago. And this is kind of blending US, international, emerging stocks, bonds. And Brian can share with you these allocations. What you see is that the longest these global balanced portfolios, 60-40, have been on the water is 2 years. By the third year, you're back in black. So this balance does help. Having global does help. It's not meaning that you're not going to lose money. It's just that you will mitigate the downturns either in terms of length or magnitude.
Okay, we've got 3 questions here that are actually sector-based. So since we're running a little short on time, I'm going to ask them all together. With people staying in place and not planning travel in the near future or even foregoing travel in future years, what do you see the travel and leisure industries performing in this situation? Also, what do you foresee happening in real estate market? Is it a poor time to think about purchasing a home? And what sectors do you see performing best over the next 12 to 24 months?
Geez, there's a lot there. Maybe I'll take a quick stab and then kick it to Apollo. We tend, for the most part, we don't focus too closely on sectors, but more on types of securities and different risk profiles. But I think within there are a couple of planning questions. One particularly about the house. I don't know if buying a house is a decision based solely on your forecast for where real estate is going. I think that there's a lot of things that go into that decision. One of them at the top level would just be, do you want a home, right? I mean, I think that there are human considerations beyond just the financial in deciding whether or not to buy a house. And then when it comes to the financial consideration, there's, one choice is what's the market going to do for housing over the next 12 months? But there's also your all-in home payment, and interest rates on mortgages are pretty low right now. And so if you can buy a home that you like at what you think is a reasonable price with a low and attractive fixed rate mortgage, and you're not planning to move for a long time, maybe that timing element becomes less important and maybe you look for a house. And then obviously with your financial advisor, you can run it through your cash flows and see, hey, what's the impact of you buying a house now versus buying a house in a couple years versus renting indefinitely, and which leaves you better off financially. On those other sectors, I'll kick it over to Apollo, except to point out that the leisure and hospitality or retail sector, I would point out that as a percentage, although there's a lot of jobs out there in that sector, and although there's a lot of establishments we're all familiar with, as an actual contribution to the stock market, it's something on the order of 7% of earnings for the broader market. So although we tend to be really familiar with those companies as a contribution to corporate America from an earnings perspective and also from an economic perspective, they're not quite as impactful as you might think, which is oddly enough, one of the, I don't want to call it benefits, but one of the silver linings in everything that's going on is that a lot of the sectors most impacted by shelter in place are not quite as impactful on the overall economy in corporate America as some of the sectors that were most impacted in, let's say, 2008, which were banking and construction, which are much larger components of the economy. Apollo, your thoughts on those?
Yeah, no, I think those are really good points. I would only add that two things. One is just a broad comment that everybody's looking to see what will do well for the next 12 to 24 months. Everybody wants to know what's the sector And I'll give you an example. I mean, you mentioned the airlines. The airlines probably lost about half to 2/3 of their value. And on the other hand, you have what might do well. You have this technology that we're using right now, Zoom. And it turns out that for this year, Zoom, as of last time I checked, which is a week ago or 2 weeks ago, it doubled in value. So what it basically means is that by the time you look for these sectors, by the time you're trying to find out what's going to do well, there's a very good chance that you're not the only one. So the market is likely to bid up these prices. So when you look to buy them and say, aha, this is going to do well, you might be paying a really pretty penny for that. And talk about houses. If you have two houses on the same block and one sells for $100 a square foot and the other one $400 a square foot, well, if you really want to buy and flip and make money, it probably the low cost one, it might be more worthwhile. But the $400 one makes you feel better. You look better in that house. So some of these that they might do all over the 12 to 24 months, it's possible that many of them, which are obvious, the price is already bid up. So you're paying a lot because you're buying this remodeled house like a Zoom, and you might be paying a lot. The other comment that I would make is that the system that we share with Pure, we want to capture opportunities, but we want to do it in a way that is different. Because if you look at it and saying, if this is the entire market, and I'm going to pick certain sectors or companies and leave out everything else, you basically are placing some pretty concentrated bets. And if it works out, then you can certainly make a lot of money. And if you don't, if you're really concentrated, it can go all the way to the other side. What we're saying, our value proposition is not come to us because we're going to shoot the lights out for you. We'll pay attention for you. We'll do all this. But what we want is to include these, sectors alongside many others investments, such that not any one sector or company will materially impact your portfolio in a good way or a bad way. Because right now, as I said, we have about 12,000 companies in 40 countries. And what we're trying to do is grow your money in a more responsible way that shrinks the range of what can happen with your money. We're not going to concentrate at the point where you're going to shoot the lights out. But you also are likely to lose all your money, because if 12,000 companies in 40 countries disappear at the same time, well, we all have bigger problems. We're like Mad Max days. So that's just unlikely to happen. But that's the value proposition is we want to look for these, but we don't want to place bets on your behalf, because if we're wrong and we concentrate, yes, it could work out. We don't want to be the casino player in a way. We don't want to be the casino player. We want to be the casino house where we look at all the bets and we tilt the odds of investing in our favor. And the way you do that is by really buying and investing around the world.
All right, we still have most of our attendees on, so I think we should finish up with one last question, if that works for both you, Brian and Apollo.
Sure. Yes, for sure.
So what strategies should be employed if inflation, which we haven't seen much of during the past few years, rears its head? What is your sense of inflation becoming an issue?
Brian?
Sure, yeah. I mean, again, I don't have a crystal ball. My sense would be that at least in the short term, deflation or disinflation is probably more of an issue than inflation, right? I mean, we're in an environment where we're in a global economic, not slowdown, but shutdown. I don't think inflation is going to pop up in the next several months. Longer term, who knows? I mean, I think that if you wind up with, if one of the outcomes of this is less globalization and companies bringing supply chains back home, as well as needing to fund the deficit, I think you could argue those are a couple of things that could potentially be inflationary. But I don't spend a lot of time worrying about inflation, even out in the intermediate term, for a couple of reasons. One is it's beyond my control, and it also hasn't popped up for several decades. But the other one is simply the kinds of investments we own are relatively protected from inflation. If you look in the long run, stocks tend to do okay with inflation, at least as you expand out your time horizon. We have some natural resources holdings, which again tend to do okay with inflation. And then the asset class that suffers the most with inflation are bonds, and in particular longer term bonds, because another term for bonds is fixed income. And when you get those fixed coupons and that fixed maturity and principal payback, it becomes less valuable when inflation is higher. The longer term the bond, the more sensitive it is to higher inflation. We don't own a lot of long-term bonds. And in fact, we just recently, in the last several weeks, shortened the maturity of the bonds that we did hold, which weren't very long to begin with. So I don't think that the bond portfolio that we hold for all of you is tremendously sensitive to inflation. So certainly something to keep an eye on, but not something that keeps me up at night at this point.
We do have just a few more questions, but I think we've run out of time. So your advisors will be able to answer those for you directly. We will send them on to your advisors. And I want to thank both of you for joining us today and all of our attendees as well.
Sure. Thanks, Andy.
Well, thank you so much. And
yeah, Apollo, thank you so much for joining us. We know you're really busy right now, and this was awesome. It was great having you on, and like I mentioned at the beginning, not only are you really smart, but I think your ability to explain things in terms that really resonate with people is valuable. So thank you for your time. And most importantly, thank you to all of you out there listening. We know that this is a difficult time on a personal level for a lot of people. And then certainly financially, it's been a little bit of a difficult environment and economically. The whole team here at Pure is here for you. If you have any questions that either you didn't get answered on this webinar or that pop up later, reach out to your advisor. They're there for you. Reach out to myself. I'm happy to chat with you on the phone, via email. Reach out to Joe Anderson. We're all here for you 24 hours a day, 7 days a week, essentially. This is what we do. This is the time that we're here for you more than ever. And along those lines, we're going to continue to do these webinars too, for as long as there's demand. It seems like there continues to be a lot of interest. So we'll be back next Tuesday with another market update, another planning update to keep you informed of everything that's going on in the markets, in the economy, in the world, and here at Pure Financial. With that, everybody stay healthy, stay safe, and thank you very much. Have a good week. Bye.
Bye-bye.
Thank you.